Hello everyone, it's Dwayne Malone with ECAM. Welcome to the ECAM market update as of Tuesday, the 20th of September, 2011. Just a quick market review. Last week the markets were up about 5 to 6% on the various averages. It was a good week in the markets. It was up 5 days in a row. And yesterday we were down fractionally, down about 1% in the S&P 500 index. I've got the daily chart up on the screen currently. As I spoke about previous, we do have this bear flag shown by the black lines. We did try and break down below that flag pattern on Monday, but as you can see, we had a tail down and we came back up. That was a week ago Monday. And then we maintained within the flag, and once again we are currently rising within the flag. It has been a little long for a bear flag pattern to remain intact, so I believe maybe we're going to a different type of pattern. I'm sort of tentatively looking at perhaps just this consolidation area with about 1220 as the high. As you can see, we've hit it several times now and been able to unable to break above it. Once again, holding about 1120 is the low, so it's about a 100-point consolidation zone. I don't believe we'll have enough oomph to get considerably above the 1220 level. Currently, the 50-day moving average is at 1225 and moving downwards, so this will provide some downward pressure onto the markets as it comes down towards 1220. So I would anticipate we're probably somewhere near our peak for this dead cat bounce. And on any significant market advance over the next couple of days, I'll be looking to take my profits and move into 100% cash. So I'm still holding my 50% equity positions, 50% cash, but as I said, I'm looking for a excuse to exit this market. The next chart is a 60-minute chart of the S&P 500. And once again, I just want to point out the flag pattern I just spoke about previous in black. We did try and, as I said, break below it Monday last week and came back into the pattern. The pattern normally would have broken down at this point, so the flag appears to be turning into something else. As I said, it could be a consolidation zone. Also, it looks like we could potentially be setting up for a head and shoulders topping pattern once again, shown once again by these triangles. This would be the left shoulder. You can see major left shoulder, come back down to the neckline, then a minor left shoulder, followed by a head, followed by a minor right shoulder, followed by a major right shoulder. And this pattern will be confirmed upon a break below this neckline here, which is currently sitting at about 1145 or so, 1150. If this pattern did break down, once again, the height of the pattern is from 1230 down to about 1130, so it's about a 100-point pattern. So if and when we broke down, say around 1150 or so, then we'd be looking at about 1050 for our target based upon the head and shoulders pattern, which would be probably very close to where my initial targets would be once we do start our next decline. The next chart is a 6-month chart of the US dollar index. As I talked about previous, we were within this trading range since beginning of May, between about 73.50 and 76. We broke out above that range late last week, got above the box area here, and also above this previous support line here at around 76.20 or so. We've come back down in the last week on Thursday and Friday to test that level, and that level appears to have held. So as long as we maintain above this current support level, I'm obviously bullish on the US dollar, and consequently I would be bearish on other currencies such as the euro, the Aussie dollar, the Canadian dollar, the British pound, and consequently as well bearish for the markets because of the inverse correlation between equities and the US dollar. Strong US dollar will be a negative for equities. So they're holding up fairly well given the strength of the US dollar, but as the US dollar becomes stronger, I expect it's going to have its effect upon equities and eventually start to push equities back lower again. Next chart is a daily chart of gold spot price. I know many of you are interested in gold and maybe holding gold positions or looking to add to your gold positions. Gold is now in a short-term downtrend. As I spoke about previous, when we were up here back in mid to late August, we were considerably overbought with the RSI well above the 70 to 80 level. In fact, got up to almost 90, which is a very, very high overbought level. It is now correcting back down. As you can see, we broke support several days ago at around the 1810 level, and we are currently sitting down here, closed yesterday at 1780. You can see that the pivot is located here at around 1823 is the pivot point. So that's our pivot there shown with this purple. Below the next level of support is 1723. Above that we've got our previous level of support here at 1750. So I would look to perhaps 1750 as being a support zone. If that breaks down, then 1723, next level of support is the 1665 level, which does line up quite closely with this previous level of support. The 50-day moving average is 1732 and rising, so that could provide some support around the 1750 level. Otherwise, if that breaks down, as I said, we're probably looking at around the 1665 level. Currently, the 100-day moving average is at 1626 and moving up. So that by that point would probably provide us with about a 1650 to 1660 area, which would probably be a good point to add to your positions if you are looking to add to your gold positions. Next chart I want to talk about is my Elliott wave chart. I currently believe that we're in the midst of an ABC correction from the 1370 top, which was a 5-wave advance, annotated by these black numbers 1, 2, 3, 4, 5. And then we're in the midst of an ABC. The A wave was from 1370 top down to the 1101 bottom that we got in early August. That followed a ABC pattern shown in red. And then following that, we're currently in a B wave up, which is also going to take the form of an ABC correction, A, B, and we are currently within C. I anticipate that C would top out somewhere between 1230, which is the level of A, or just slightly above that. You can see the 50% retracement level on the Fibonacci was at 1236. The 6180 is at 1267. So somewhere between 1236 and 1267 would be a good point at which we would top out for the end of our B pattern. And at that point, we would start our C wave down. I believe that the C wave down, once again, should take the form of a 3-wave correction with an eventual low somewhere right down here at the 100% retracement of the initial climb, which would be down to 1010. That'd be my first target based upon Elliott wave. There is other targets below, but that would be my first target. And when we get there, we'll have to have a look and see if it holds, or if we have to, in fact, revise that target downwards. But I do believe we are heading lower once we top out at the end of this current B wave, and that could be coming any day now. So once again, in summary, I am currently maintaining my 50% equity long positions, 50% US dollar cash positions. I believe that this is a dead cat bounce off of the 1101 lows. I believe that we are somewhere near the top of our current rise, and I would expect we're going to roll over from here back down to levels around 1010. I have levels below that around 965 to 985. But once again, once we do roll over, we'll have to have a look at that. But for right now, I am bearish long term. The weekly and the monthly charts, which I didn't show today, are both bearish. And I am looking to move to a 100% cash position if and when the markets start to roll over. Once again, thanks for listening. This has been Dwayne Malone with ECAM.